Okay, let's just rip the bandage off right away because if you are looking at your screens today, it's Monday, February 23rd, 2026, and it is just ugly out there.
Yeah, it really is.
Bitcoin has officially hit a 2-week low. We're clocking in at $64,293. And, I mean, the charts are just bleeding red right now. The sentiment is terrible. And if you're just casually scrolling through the headlines today, you'd think this is just your standard panic-driven market correction.
Well, I mean, it certainly feels that way on the surface. We breached that psychological $65,000 support level, and honestly, the momentum right now is strictly to the downside. It feels very heavy.
And this is exactly why we do these deep dives for you guys. There's a massive contradiction burying itself in the data today.
A huge divergence.
Right. We have the price crashing, we have major corporations openly dumping their holdings, and yet we have this report from the CFTC suggesting that the so-called smart money, the big speculative funds, are actually betting heavily in the exact opposite direction.
That is the mystery we really need to solve today, because we are looking at a market at a complete crossroads. On one hand, you have this liquidation cascade playing out, plus, geopolitical war drums beating in the background.
Yeah, the geopolitical stuff is intense right now.
Exactly. But on the other hand, you have this fascinating divergence in trader behavior. Plus, we've got a report about stablecoins today that suggests the United States national debt might actually soon be structurally dependent on the crypto market.
Which is, that stablecoin report is actually mind-bending. And we are definitely going to get there because the implications for the U.S. dollar are wild. But first, we have to deal with the immediate bleeding.
Right, the price action.
Yeah. We're sitting around 64,200. What exactly triggered this specific drop? Because 65K was supposed to be the floor, right? Like that was the line in the sand everyone was watching.
It was. It was a primary accumulation zone for a lot of quantitative trading desks. But, markets tend to punish obvious levels. Once we slipped just below that $65,000 mark, we triggered what's known as a liquidation cascade.
We hear that term a lot, liquidation cascade.
Yeah.
But let's actually break down the mechanics for everyone listening. It's not just people panicking and hitting sell on their apps, is it?
No, it's way more mechanical than that. Think of it like a row of dominoes. You had a lot of retail traders and institutions who went long last week.
They were betting the price would go up.
Exactly. And to protect themselves, they set stop-loss orders just below 65,000.
So they're basically telling the computer, if it drops below this number, get me out immediately.
Right. But here is the catch. A stop loss on a long position is effectively a market sell order. So when the price ticks down to, say, 64,999, all those automated sell orders fire at once.
I see.
And that sudden selling pressure pushes the price down to 64,900, which then triggers the next layer of stop-loss orders from traders who had their safety net just a little bit lower.
So selling literally triggers more selling, which drives the price down, which triggers even more selling. It's just a vicious feedback loop.
Precisely. It amplifies the downward velocity. That's why you see these really sharp vertical red candles on the chart today. But, and here's where it gets really interesting, while the spot price is tanking, we got the Commitment of Traders report.
The COT report.
Yeah, from the Commodity Futures Trading Commission. And it shows something very strange regarding non-commercial traders.
And just to clarify for everyone listening, non-commercial is the regulatory speak for hedge funds and speculators, right? We aren't talking about, like, farmers hedging wheat production here. We're talking about money managers.
Correct. These are the institutional speculators. And the data shows they are net long.
Wow.
Yeah. They are accumulating long futures contracts at an accelerated pace, even as the spot price drops.
I have to be honest, that sounds more like a gamble than a strategy. If the price is crashing and the quote-unquote smart money is buying, maybe they're just wrong. We've seen hedge funds blow up before.
Oh, absolutely. That's a very fair pushback.
Yeah.
They could completely be wrong. Being an institution doesn't magically make you clairvoyant, but the difference here is the time horizon and the math. A retail trader is typically selling right now because they are scared of the price action today. But the funds are buying because their models show the price is mathematically deviated from its average over the last month.
So they're betting on mean reversion.
Exactly. They view this price drop as a statistical anomaly, a deviation that just won't last. They're essentially absorbing all this downside risk because their algorithms are screaming that the asset is oversold. They aren't trading the news, they're trading the math.
Okay, so the funds are betting on a bounce in the futures market. But someone is definitely selling the actual asset. We can see it in the spot price. If the funds are buying futures, who is dumping the actual Bitcoin? because you can't have a crash without massive sellers.
That brings us to the exchange whale ratio. It just hit 0.64 today.
0.64.
Yeah. And that is the highest reading we've seen since October 2015.
2015. I mean, that is ancient history in crypto years. That's pre-bull run 2017. So what does a 0.64 ratio actually tell us?
It measures the size of deposits hitting the exchanges. A ratio of 0.64 means that 64% of all Bitcoin being deposited onto exchanges right now is coming from the top 10 largest transactions.
Oh, wow.
Yeah, so this isn't thousands of retail investors panic selling their $500 positions. This is highly concentrated, institutional-size selling. We even saw a single transfer of 11,000 Bitcoin, which is worth about $760 million, move from cold storage straight to Binance.
That is a massive amount of supply
Yeah.
to hit the order books all at once. Nearly $1 billion in one move. So let me get this straight.
Right.
We have speculative funds betting the price will go back up, but actual whales are moving nearly $1 billion to exchanges to sell.
It creates a totally bifurcated market. The derivatives market, the bets are bullish, but the spot market, the actual asset, is incredibly bearish. And it's not just the anonymous whales either. We are seeing a genuine exodus from the traditional institutional vehicles.
You mean the ETF?
The ETF.
Which is wild, because the ETFs were the absolute darling of the industry for so long. They drove the last all-time high. But looking at our notes here, they've been bleeding for 5 straight weeks.
5 straight weeks of net outflows, totaling about $4 billion. And just this week alone, we saw another $288 million leave the global exchange-traded products.
Can we pause on the mechanics of that for a second? Because I think a lot of people imagine an ETF is just like a vault. If I sell my share of a Bitcoin ETF on my brokerage app, why does that actually force the price of Bitcoin down? Doesn't the ETF provider just give me cash from the reserves?
That's a super common misconception. Think of the ETF more like a warehouse receipt. The ETF issuer holds the Bitcoin in a custody warehouse. If you, the investor, return your receipt to get your cash back, the warehouse manager, who is known as the authorized participant, they can't just give you money from their own pocket.
Right.
They have to go into the warehouse, take the actual physical Bitcoin, sell it on the open spot market to raise the cash, and then give you your money.
So my random sell order in a regular stockbroker's account eventually turns into a literal sell order on a crypto exchange.
Exactly. That $288 million outflow translates directly into limit sell orders on the spot market. It creates this constant robotic selling pressure every time Wall Street gets nervous.
And it sounds like the ETF industry is really starting to feel the pain from this. I saw CoinShares slash their fees massively today. Is that related?
It's a direct symptom of what we call the fee war. Trading volume on these products has completely dried up. It dropped to $17 billion, which is the lowest since July 2025. So to survive and keep capital from leaving, CoinShares cut their management fee from 0.98% all the way down to 0.15%.
Wow. From basically 1% to almost zero. I mean, that just screams desperation to keep customers in the door.
It's a purely defensive move. They are trying to stop the capital flight. But it's not just the investment funds de-risking right now. We are seeing a major shift in the corporate narrative, too. You remember the whole diamond hand strategy?
Yeah, the classic permanent reserve model. The idea that a company would put Bitcoin on their balance sheet and just hold it forever no matter what.
Well, for a lot of companies, that strategy is completely cracking under pressure. We have data today showing corporate treasuries are on a 3-week selling streak. Kango Inc. just sold 54% of their entire stack.
More than half.
Yeah. And even Winklevoss Capital is down from 23,000 Bitcoin to 11,000 Bitcoin year over year.
That is actually really significant. Winklevoss Capital, they are OG believers. If they are selling down their stack, that sends a pretty grim signal to the market. It means they're treating Bitcoin like any other liquid asset to cover operational bills, not a permanent vault.
Exactly. When interest rates are high and operational costs are rising, ideology kind of goes out the window. They treat it like any other asset and sell it to raise cash. But there is one massive outlier today.
I think I know who you're going to say. Strategy Inc.
Strategy Inc. While literally everyone else is de-risking and selling, they filed an 8K form today. They confirmed the purchase of another 592 Bitcoin.
That feels almost defiant at this point in the market cycle.
It really is. They now hold 717,722 Bitcoin in total. So while the rest of the corporate world is running for the exits, this one entity is just stubbornly doubling down on the permanent hold thesis.
So Strategy Inc. is treating it like a permanent vault. But for everyone else, the people selling that $4 billion out of the ETFs, the world just looks way too scary right now to be holding volatile assets. And that fear isn't just coming from the charts, it's coming from the news cycle. We have to talk about the geopolitical catalyst.
We really do. You can't ignore the macro environment. The market is clearly reacting to the news regarding the U.S. and Iran.
Right, the March 2nd deadline. Now, we're just reporting on the sources here, but the situation is escalating quickly.
Yes. The U.S. has set a hard deadline for nuclear negotiations for March 2, 2026. According to the reports, the Iranians are refusing interim deals. The U.S. has deployed carrier strike groups to the region. The tension is incredibly high.
But wait a minute, I have to play devil's advocate here for you. Isn't Bitcoin supposed to be digital gold? I mean, the narrative for a decade has been that when the world goes to chaos, when the war drums start beating, you buy Bitcoin because it's a censorship-resistant safe haven outside the banking system. So shouldn't the price be rocketing up right now?
That is exactly the narrative the maximalists love to push. But the hard data today proves otherwise. And honestly, this is the critical aha moment for this entire deep dive. Look at physical gold right now.
It's holding steady.
It's holding steady. It is doing its exact job as a safety net. Bitcoin, on the other hand, is dumping.
So the whole safe haven narrative has basically failed the test.
In this specific stress test, absolutely yes. Institutional investors are simply not treating Bitcoin like gold. They're treating it like a high beta technology proxy.
High beta technology proxy. Can you translate that into plain English for us?
Basically, Wall Street views Bitcoin as a risky tech stock on steroids. When the geopolitical situation gets scary, investors rush to cash and proven safe assets like government bonds or physical gold. They sell the risky stuff first. And right now, regardless of the cypherpunk ideology, Bitcoin is categorized in their portfolios as risky stuff.
It's the first thing they liquidate to get cash.
Exactly.
That is a really tough reality check for the digital gold crowd. The theory sounds great in a white paper, but the actual market behavior says something entirely different. So, we have a price crash, heavy institutional selling, and a massive geopolitical reality check. It all feels pretty gloomy today. But looking at the back half of our sources, it seems like while the price is suffering, the actual infrastructure, the plumbing of the crypto world is getting built out faster than ever.
That is the grand dichotomy of this market. The price action is incredibly loud, but the infrastructure build is quiet. Adoption hasn't stopped at all. It's just changing its shape. Just look at what is happening in South Korea today.
This is the Hanwha Asset Management news.
Yes. Hanwha is a massive traditional institution. They manage over $4 billion, and they just partnered with the Ito Foundation. They are building a liquid staking ETP on the Solana blockchain.
Okay, liquid staking ETP on Solana. That sounds like an absolute word salad of crypto buzzwords. What does that actually mean for, say, a normal investor or a traditional pension fund? Why does this matter?
Think of it this way. Usually, if you want to earn yield on a proof-of-stake blockchain like Solana, you have to lock your coins up in a smart contract. It's highly technical, it carries smart contract risk, and traditional pension funds simply cannot deal with managing digital wallets and private keys.
Right, they need traditional financial plumbing.
Exactly. So what Hanwha and Fido are doing is packaging that complex crypto yield into a boring, heavily regulated product that trades just like a stock.
And where does that yield actually come from? Because the notes mention something called MEV, maximal extractable value. That sounds like a corporate buzzword too. What is it really?
It sounds super complicated, but think of it like being in a really busy line for concert tickets online. MEV is essentially the ability for a specialized computer program, a robot, to spot that you were trying to buy a ticket, quickly cut in line ahead of you, buy it first, and then immediately sell it to you for a tiny bit more money. It is pure arbitrage.
Honestly, that sounds incredibly predatory.
In the wild west of DeFi, it often is. But this new institutional product captures that line-cutting fee, the arbitrage profit, and actually gives it back to the pension fund investors as yield.
Oh, I see.
It turns a structural bug of the blockchain into a feature. It transforms crypto from a purely speculative digital rock into an actual yield-bearing financial instrument. It's a massive, massive step for institutionalizing the technology.
So they are basically sanitizing the messy, complex parts of crypto for the big money. And it's not just happening over in Asia either. We've got major movement right here in the U.S. at the state level. Missouri is making waves today with House Bill 2080.
This is a fascinating development in what we call the sovereign model. While Wall Street is panic selling out of ETFs, the state of Missouri is actually trying to build a strategic reserve fund.
A literal state-level Bitcoin reserve.
Yes, and it comes with a mandatory 5-year lockup period. The bill explicitly states that the state government cannot sell the acquired Bitcoin for at least 5 years. It's a legally forced scarcity mechanism. Plus, they are allowing citizens to pay their state taxes in Bitcoin through a third-party conversion provider.
That is the complete opposite of what the corporations are doing right now. The corporations like Kango are selling just to cover their quarterly earnings reports. But Missouri wants to lock it away for half a decade. That difference in time horizon is just huge.
It really is. Wall Street thinks in financial quarters, states think in terms of legislative sessions and long-term pension solvency. The signal here is very clear. State governments are beginning to look at this asset very differently than the federal government or your average Wall Street day trader.
So we have this massive tug-of-war happening. Wall Street is fleeing risk assets, but states and foreign financial institutions are quietly building this long-term infrastructure. But there's one more report in our stack today. And frankly, this one scared me a little bit when I read it. It's the Standard Chartered report on stablecoins.
Ah, yes. This is the macroeconomic heavy hitter for today. This report connects literally everything we've talked about directly to the traditional global financial system.
The headline number here is that Standard Chartered projects stablecoins, which are basically just crypto dollars, will hit a $2 trillion market cap by 2028.
$2 trillion. Just to put that in perspective for you, that is larger than the entire M2 money supply of many developed nations. But the real story here isn't just the sheer size, it's what actually backs that value.
Right, because to issue a stablecoin that stays pegged to the US dollar, you usually have to hold collateral in a bank account somewhere. And typically, that collateral is US Treasury bills.
Specifically, short-term Treasury bills. The report estimates that in order to back $2 trillion in stablecoins, these crypto issuers will need to go out and buy between $800 billion and $1 trillion worth of short-term U.S. government debt.
That is a staggering amount of money.
Yeah.
$1 trillion of pure buying pressure on U.S. debt.
It is so much money that Standard Chartered literally predicts it might force the U.S. Treasury to change how it issues its debt.
Wait, let that really sink in for a second. You are saying the United States Treasury, the absolute bedrock of the entire global financial system, might stop selling long-term bonds just because a bunch of crypto companies suddenly need short-term bills. That sounds absurd.
It sounds completely absurd, but it's just a raw supply and demand reality. If there is a sudden $1 trillion wave of demand for a very specific type of short-term bill to back these stablecoins, and the Treasury doesn't print enough of them to meet that demand, short-term interest rates go absolutely haywire. The Treasury wouldn't be doing it as a favor to the crypto industry. They would be forced to do it just to keep the U.S. yield curve from breaking. It is the ultimate case of the tail wagging the dog.
So they might actually suspend their 30-year bond auctions just to print more short-term paper for crypto collateral.
That is exactly the scenario the report suggests. They might have to fundamentally shift their sovereign issuance strategy just to feed the crypto market's hunger for safe collateral.
That is wild. We spend so much time on this show talking about whether the government is going to ban crypto or regulate it out of existence. But this data suggests the government's own financing operations are actually becoming structurally dependent on crypto.
It directly links the stability of the U.S. dollar to the health of private stablecoin issuers. Think about it. If the Treasury is tailoring its sovereign debt issuance to accommodate stablecoins, you have crossed a major Rubicon. The digital asset market basically becomes a primary consumer of U.S. debt.
So wait, if the crypto market crashes hard, or if there's a massive bank run on stablecoins, suddenly the U.S. Treasury has a huge problem on its hands because their biggest buyer of short-term debt just vanished overnight.
That is the exact systemic risk. It creates a bidirectional dependency. The U.S. government needs the stablecoins to buy their short-term debt to fund the government, and the stablecoins desperately need the U.S. debt to back their digital tokens. It integrates the decentralized crypto economy right into the very heart of the centralized traditional financial system.
Which brings us all the way back to where we started today, this strange, incredibly messy day, February 23rd, 2026.
It is truly a day of massive contradictions.
On the surface, it looks like a disaster for the industry. The price is down at $64,293. We have this brutal liquidation cascade. War risks in the Middle East are spiking. Major corporations are dumping their holdings. And the whole digital gold safe haven narrative is taking a massive beating.
But when you look underneath that surface chaos, the structural macro shifts are just profound. Speculators are betting heavily on a long rebound. Institutions in South Korea are building regulated yield products. The state of Missouri is trying to legally lock up supply for 5 solid years. And the massive U.S. bond market is potentially reshaping its entire issuance strategy just to digest $1 trillion of crypto demand.
It's almost like the daily price action is just a distraction from the plumbing getting installed.
The price is the noise.
Yeah.
The plumbing is the actual signal.
So here's the final question I want to leave you with today as you process all of this.
Right.
We have spent years in this space asking if the traditional financial system will ever finally accept crypto. But looking at that Standard Chartered report today, if the United States Treasury actually changes its sovereign debt schedule just to accommodate stablecoins, has crypto been tamed by the system? Or has the system quietly become dependent on crypto just to keep the lights on?
That is the trillion-dollar question right there. And honestly, looking at how fast this is moving, I really don't think we'll have to wait until 2028 to find out the answer.
Thanks for diving in with us today. We will be watching those price charts and definitely that Treasury auction schedule very, very closely.
Stay curious out there.
See you on the next Deep Dive.